Hi, everyone. Welcome to another episode of the Fulfillment Tools webcast Treasure Chest. My name is Linda. I'm co-founder and managing director at Fulfillment Tools, and I'm very excited about the topic we are talking about today, venture capital. So venture capital is a very critical element in really the journey of any scale-up because it enables us to grow, to innovate, and to bring our visions into life. Today in the episode, we deep dive into how to navigate in the venture capital landscape and what the view of venture capitalists is in the current market environment, what their opinion is about investments and how they approach investments. And I'm super thrilled to be joined today by a seasoned expert, by somebody who has a lot of years of experience in the industry, who has backed numerous very successful startups. Welcome, Stephan Wirries, partner at VenTech. Hi, Stephan.
Hi, Linda. How's it going? I think you forgot one really important aspect is that we started together like 15 years ago at the same company. So you probably have about as much experience in the industry, just maybe you switched tables at some point, but
Yes, I did.
you know a lot about VC.
I moved to the good side.
Yes, one might say that.
So yeah, 15 years ago, yes. So maybe you want to start introducing yourself to our audience who don't know you yet, and maybe include how we met.
Yes, fantastic. I started in VC as an intern working for you at a firm that's today called Headline VC, and briefly after that I had the chance to join another VC firm in France. It's a longer story, one that connects personal life and a big opportunity to basically bring a new team up within a VC firm. That VC firm is called VenTech. Maybe briefly talk about who VenTech is in case you don't know us. We've been in the market for 25 years. Generalist early stage tech investor with 7 partners. We're multi-specialists, so each of us have 2-3 topics that we're really investing in. On average, the average VC experience of a partner at VenTech is 18 years. So we're one of the older, maybe not the oldest, but one of the older VC firms in Europe. And you're speaking to maybe one of the younger partners in that team. The ambition is to really find the most exciting companies, mostly in B2B, and bring them, make them really big. I specifically, and that's also good that we're speaking today, focused on the software space. I'm a software engineer by training, did a bit of business, and I always wanted to be an entrepreneur. Then I had this fantastic exposure in VC, and I was so much in love with talking to founders that and working with them that I just got stuck. I could say that in a way. And maybe to conclude on VenTech, we're based out of Paris, out of Munich, Berlin, Helsinki, Stockholm. We have a team in China, Southeast Asia. And if you're deeper in the VC industry, you might ask, hey, where are you investing actually? Because it's such a big field. You can think about the growth rounds when you hear about it in the media. We're investing much earlier, so usually tickets of 1 to 5 million euros. Rather closer to the inception of the company, sometimes being the first institutional investors. What we proud ourselves often, I think it's important, especially in these times, we always want to be a leader or co-leader in your round, meaning we want to work with the founders, we want to be on the board. We think, especially when the times are a bit more, and it's the topic today, a bit more rough, maybe with more ups and downs. It's super important to have conviction when you join a company and be there for the long run, because these are not short investments. Very often they take 5 to 12 years. And super thrilled to be here, Linda. It's super nice to see you again, and after so many years have this chance to speak.
Absolutely, I totally agree. And maybe also to be very transparent, there's no investment affiliation between our companies whatsoever. It's really just former colleagues talking about venture capital. So let's dive right in. What's your view on the current funding market? Because it feels like there were like historical highs in 2020, 2021, high multiples, high valuations, and right now we've come to lows that I haven't seen in many years. What's your view on the market. Is that true? Would you agree, or do you have a different opinion or a different view of the market?
Yeah, I think the variety is much larger. So you still have these mega rounds, a lot of interest on certain topics, very high multiples. And it's especially true if you're in a very exciting topic with one company in our portfolio called Prewave out of Austria that's in the supply chain risks analysis space using AI to basically enable you to find any issue very deep in your supply chain globally. And as you can imagine, since COVID, this is a huge topic for everyone. So that's a lot of excitement around it. And then you have the more normal outcome where maybe you're starting out, maybe you don't know 5 VCs already as friends, maybe you haven't started a company before. I think for the average, of course, it's much harder these days. It doesn't mean that companies don't get funded, because there's lots of funds who have money. There's a bit of time effect, if you want to call it this. As you know, interest in the capital markets was rising, capital is less available, and so it takes longer for the capital to reach, for the valuations to be settled, for the expectations to be settled. And I think companies are still being funded, just maybe at lower valuations. And sometimes it takes a moment for that to settle, so to say, in the market. It doesn't necessarily mean the companies are less exciting. I think they're just as exciting. It just means you need to be more ruggedized, more focused, maybe think a little bit more where you are in the competitive landscape. Think, just as I mentioned earlier, Prewave in the supply chain risk space, if you pick a topic that's either highly competitive and has been captured already, or if you go into the green field and you're very early in a wave, both have their challenges, right? You might jump into a space that already has a lot of attention, but then what's different about you? Or you might go into a space where you have to explain it, and both depend then on your ability to explain that story, your market, your specific competence, and that determines very much the interest you can generate. And in the end, it's not a science valuation of companies. I think it's much a very human art and a matter of negotiation, competition, finding a deal together, and building a story that your investor can believe in with you together.
Interesting. So if you meet a founder today that wants to raise or needs to raise funding, I read very often that founders are advised to steer the company more towards profitability, where I always think, especially in the early phases, it's not really possible. It's not really possible to balance hyper growth and profitability. At some point in the journey, that is possible. You can turn a button and then it's a little bit easier. But especially when you talk about Series A, about the ticket size you just mentioned, what advice would you give founders? The same, or how do you think about it?
It's a super interesting aspect, and I think it's that the word profitability is just way too broad in a way when you think about it, because there's so many ways to think about profitability. You even, if you look at public companies, they always say EBITDA and then with an asterisk, right? And that just tells you so much about what people think about profitability, because everyone has an adjusted profitability. And so for startups, there's no need, if you want to go the VC route, that's maybe the first question. If you want to go the VC route, there's no need to be ultimately net profitable, but think about your margins. Try to go basically all the way close to your first customers. How much can you generate? What's coming back to you after you've provided the service? And if you think through that whole P&L, your balance sheet, everything that's connected to that, profitability ultimately, and the cash flows. Maybe you're getting paid very early, or maybe you're getting paid very late, but you have to provide the service first. There's so many questions connected to it. And it's important to discuss that, even if it's not completely clear how it might look like with your VC, because it has huge implications as to how much money you need to build your story and grow and capture a certain segment of the market. And I think what's important is the discussion around it. It's not necessarily that you have to achieve it immediately or in a given time frame. It just has to make sense given what you achieve, what it's worth, then as a company. In terms of driving your equity value and maybe future investors, or maybe someone who wants to buy the company, or investors buying it on the public stock market. And that's why it might seem very analytical and financial from a founder perspective. You're an operator and you come with your idea, but it's good because you're looking at the result and you're trying to go backwards and trying to understand what has to happen to get there. And as the money is not free anymore, unfortunately, and also we have to at least make the thought experiment, I think. And so it's not important to be immediately profitable, but maybe make sure that you kind of have something that's sustainable. If I make it very very vivid, I'd say compare the electric scooters that you could have for a couple euros, and if you just think about, did that make sense that you could get such a thing that probably breaks all the time and is lying always on the sidewalk? And there lots of businesses have been funded that maybe not necessarily are destined to be very profitable. And so I think a lot of come back to the topic, and there's been VCs that always had that in the back of mind, and others who have now to really course correct and move back. And as a founder, it's just important to kind of look at the ultimate goal and what it takes to get there, and then kind of make the math. If you want to be worth, I make it simple, if you want to be worth a billion euros, does it take you €1 billion to get there, or does it take you 50 million to get there? I mean, it's a huge difference, right? And then in terms of capital efficiency, and it tells you who to talk to us, because there's different sort of capital providers and investors, and not every VC is the same sort of VC. Not every PE and later growth investor is the same sort of risk appetite. Some people really like to go very bold, very deeply into topics. It's about control. There's so many topics connected in terms of an equity and fundraising story, but profitability, I think it's a good thing that it's back as a discussion. It's maybe a bit hard because we didn't train it for a couple of years. It's back, so I think we have to adjust, everyone.
I love that you just mentioned the word sustainability, which we will talk about later.
Okay.
It's also very interesting. But first of all, like, how do you advise your portfolio companies what to focus on really in like the early stages? Is it more the product stability? Is it go to market? Is it sales? Is it brand awareness? What would be your advice? What companies should focus on the most?
Yeah, it's super situational. I think at the core, when you're at the very beginning, it's about thinking what are the things you have to prove to get to that next milestone, right? And if we had the big goal of being IPO, profitable, independent in the end, but there's so many things you have to achieve before, right? And it's first building a product, then ideally doing that together with the customer who wants to ultimately pay for it, and then getting the second customer, understanding what other segments could be interesting, then actually delivering the product and the service, because maybe you promised a little bit more than you could deliver from the get-go. And usually we come a tiny step after that. We love to come in when there's at least very serious customer discussions. Very often there's already some revenue, so we can talk to the other side and understand what the product is actually delivering, and that's a very interesting aspect. Out of these discussions, we usually learn a lot about the product and where it is today and its potential. And that discussion is an interesting one with the founders. It's probably the first one you have even before you invest. And it leads to getting to know each other. What did we learn? What does the founder learn? And from there on out, there's so many operational topics, right? So you asked, it could be anything from financial to marketing to bringing people. Where there's some funds out there who promise you the world. They tell you, we do everything for you. We're the platform. At VenTech, we've come to the conclusion that that's not very realistic. Given that, I make a simple example: the best lawyer has their own law firm. The best auditor or tax advisor has their own tax firm. So we love to be in touch with these people and put them in contact with our founders in the right geography, in the right context, because some people are best advisors for software companies, while others might be better for semiconductor IP. And so we're trying to situationally bring the right people together. That's maybe number one, but not have them on our payroll, because then everyone would get the same service, and I think it wouldn't be very, you wouldn't get the best service in the world, which is ideally what you'd have, or situationally for that stage where you are. So very often, I think it's about bringing in, maybe you're very good at selling and you're not very good at finance as a founder, and maybe you need some help there, and maybe that first hire you did wasn't the perfect one. So very often it's discussions like that then help to extend the team, bring in the right partner or advisor. what we look at a lot, and that's very abstract, is alignment, meaning that people move into the same direction. I think it's the same problem across all companies. Just at startups, it's so much more obvious. You have a founder team, you start together. In the beginning, you're all running into the same direction. Life comes, puts some of you in another direction. Some things don't happen the way that you expected them. The company's moving focus. Maybe that's not my personal focus. And so a lot of that early journey is trying to, help founders and the team and ultimately the company succeed in those circumstances. And that sometimes takes difficult decisions and to navigate those together in a pragmatic manner that's also human and really partnership driven is super important to us. And I think, if I could only do one thing, that's the number one thing we do.
Interesting. And if you so that's, you already like explained a little bit on what you bring in when you invest in a company, but isn't that what every VC says? Like, we connect you to the right people, we help you in hiring. Like, if you really have the luxury as a founder to choose between different VCs, like, I think that's what everybody says.
Yes.
But is there more to it?
I think people promise even way more than what we just said. They to be so. I think I was much more back to basics than maybe people promise in the market. And I try to focus on that because I think that's what you should reference. You should reference when you're the founder and you're making your own due diligence, which I highly recommend. The founders check your network. They're trying to figure out who you've worked with, how did that go, and just to figure out also who am I going into partnership with. The same priority should be given to you. And if I was a founder, I would always ask, hey, tell me about a company where it worked really well. Tell me about a company where maybe it didn't work so well. Can you put me in touch with both of them? And or reach out directly. I mean, people will answer. Founders are very transparent with each other, so you should always reach out. And then ask them, where did they really help and where maybe it wasn't so good. And I doubt you'll find the perfect person in the world. That doesn't exist in my human experience. But figure out if that's a partnership you want to go into. And in my opinion, it's a lot about building that relationship, especially in the early stage, right? And we're talking about you've built the product, you started to sell it. We're not at the stage where you do 50 million revenue and it's a P&L with lots of people, a big team, where it's a lot about numbers, right? In the beginning, you're telling a story, and that story has to be jointly believed, and so the promises you make also have to come true. If they don't come true, then you have a huge problem down the line.
I think that's actually great advice, to do reference checks, kind of, as you do in hiring as well. So I think that helps a lot. And so there's also a concern among founders that VCs put a lot of pressure on growth, and that you kind of lose a sustainable journey and you don't have a sustainable company culture anymore. What's your advice on balancing these two?
I think that's maybe I'll be a bit bold. It's maybe I hear that sometimes in the market, and I feel it's a bit naive notion about what the deal you're making. In a way, when you're going into venture capital, you're promising growth, and yeah, it doesn't always become true. And then I think it's important that if it doesn't become true, and unfortunately the company goes a different way. Let's assume you raised venture capital, you wanted to go to 100 million revenue, it didn't happen. You burned all the money. No one gave you money again. I think then it's very unfair of the VC to expect you to continue because the journey is over. You need to make a decision before then to ideally become profitable and find another journey, right? That's maybe where I agree with you. Sometimes that doesn't happen. Sometimes VCs then are, maybe disillusioned and a bit upset and have regrets. I wouldn't say for us that's ever the case. I think we're pragmatic enough. We've experienced it also often enough in 25 years that we know sometimes companies go a different journey. But what's important to understand that in the beginning, that's the deal you're making. The deal you're making with a VC is to say, we're building a very large company and we're trying to do it as fast as we can. Of course, efficiently, ideally, but very fast, right? I mean, you want to see a growth of, at least doubling, tripling, ideally, maybe 8 times, 5 times. It's you want to have incredible growth rates, because what you're going after, I mean, it's industry changing, shaping companies, right? Like, we want to, invest a couple million, make 5 times, 10 times that money back, right, in a given time period. And we have to deliver that also to our customers. I think sometimes what's not very transparent to founders is who we're serving. Of course, we're serving founders, but we're also serving our investors. We have to deliver money back. It's not philanthropy in the main sense. Of course, we're investing with an impact mindset and with many other stakeholders in mind. But in the end, we're about making money and bringing it back to our founders, who then also sometimes invest in the next fund, and it creates a joint incentive. But the deal we're making together is to run as fast as possible. And if that's not what you wanted to do, then ideally you don't take that money, because it's not a good fit then.
And how do you evaluate whether the growth you are seeing or the traction you are seeing is more like a very long-term sustainable growth? Because in the beginning you said that venture capital is, against the perception of many, a long-term game. It's not very short-term. It's like a 5 to 10 year game. Like, how do you differentiate between the long-term growth or like short-term gains? Because you've had, like, in the history, many companies that grew very, very quickly to very high valuations and revenues, and then just exploded or imploded, better to say. How do you make that judgment if the growth you are seeing is short term or has the potential for long term? And can you maybe share like a real life example where you had to make this judgment and were right or even wrong?
Okay, I'll give this a shot. I think it's again about breaking down what you want to ultimately achieve into smaller things. And I mean, you start to see the pattern, I guess. When you want to know, I mean, revenue is fantastic. Okay? Let's put it like this. I see a company that gets customers. I say, cool, exciting, maybe super exciting market, maybe something with software and AI, right? Everyone's excited about this right now. And so you go in and you see all these people buying, and you're like, wow, why are they buying? Can I speak to some of them? Are they actually? And then the next question is, maybe they're not. Maybe these calls are not super, insightful in a way where they don't really engage with the product, right? You're trying to understand what's the engagement, what are the qualitative factors that kind of overlap with the with the revenue you're seeing. What's the quality of the growth that you're seeing? And in many cases, it's fantastic, right? You see a customer that buys the product, uses the product, has constructive criticism, where they tell you as an investor that then talks to them, hey, it's a good product. We're missing A, B, C. If they did it, we would spend double. Sometimes people are extremely open. Yeah, we could use it in 2 other departments. Fantastic expansion potential. Then you go back, with the founders, you have a discussion. Do you see it the same way? Do you see it different? Do you see it a different way? Maybe you say you don't want to do that for another reason, because that's a distraction. That's an important topic, right? To focus on what's core to you. And so I think sustainable growth comes from delivering value first and foremost, ultimately, and you have to do it ideally at a price that pays back the cost that you're spending. Maybe not immediately, so you can make the judgment call to say, I go in the upfront investment. I mean, in the commerce space, maybe some of the listeners, because fulfillment, I think your audience is also in the e-commerce space, and historically we've invested a lot in that. And sometimes you think about your upfront customer acquisition cost, right? And it's also very important in software, and especially important in e-commerce, because maybe you have a product where people come back all the time. Maybe you have a product where people come back once or maybe twice, or maybe they come. In what cadence do they come back? Do they come back every month? Do they come back every year? Makes a huge difference as to how you engage with them, how much you spend with them, and how you extract that value and how you interact with them in far and in between, and how that value is also perceived for them, right? And I know it remains very abstract, but in a way, it's super important to get into those details to then understand, is it sustainable or not? And so that's what I do short term, and then long term, you go back after 2-3 years, you maybe serving enterprise clients over 3-year periods. You see the net retention rate, which is a KPI we like to look at. You again talk to them. You make sure the numbers make sense with the story, and you look at the concentration maybe across certain verticals or customer segments, and so you start to see a pattern, and maybe you start to see that equity story come true. And with equity story, maybe you're capturing with your software an aspect that maybe a large incumbent, maybe SAP is in your space historically serving the very large German automotives, right? And maybe you're coming in from a different angle and you're actually serving another piece that they're not serving, and so you start to see every German automotive being your client. And that's coming together very nicely, and you see you might be the solution for them to be the future, right? And that's when you see that growth is probably sustainable. I mean, we talk about it really from a financial perspective. Sustainability has really many other aspects, right? So we could talk about ESG and impact, and we have an impact fund as well, and many of our investments also have an impact angle. So I don't know if you want to go there, but it's also a very interesting discussion.
Yes, I meant more in a financial sense, but that's maybe you should do another episode on this topic.
For sure. Yeah.
Okay, now you navigated around my question of your misjudgment.
Yes.
You cannot anymore with my next question.
Just go ahead.
Because I want to ask you about your anti-portfolio.
Oh yeah.
So what are the companies that went across your desk and that you didn't invest in, where you were really, really mad about afterwards because they just took off and you just haven't expected? And what were the reasons for that misjudgment?
Yeah, well, that's very, very painful for VC, because kind of
I know.
it's your main failures, so to say, because your job is to find the best companies and invest in them, right? I have one in mind I think about probably every other month. Companies called LeanIX. They had a fantastic story selling the asset ultimately to SAP, and the company's still operating, and the founders are fantastic. It's a great team. You might know them. They're not so far away from you, Linda. And yeah, we liked them. We really appreciated the team. At the time, we had some historic concerns because that market has been so they're in the enterprise architecture space. I don't want to get too deep in the topic because it's very specific in the software stack. Essentially, they help you understand your IT infrastructure. If I make it really simple, they do much more than that. But if I make it really simple, and as you might assume, that's a topic that has been a topic for ever since IT appeared, and so it's been done before. It's been tried before, and we've actually seen it over the last. My colleagues have seen it over the last 30 years, basically been tried once or twice before. And the predecessors, some of them have not become very big. And so we had this one concern that was kind of making us a bit slow and maybe too slow to make that bet. And that to be very open, that was very painful, because in the end, I deeply regret not having backed them. And we should have. We wrote a memo internally to learn from it.
Really? Okay.
Yeah, and then sometimes you really learn from that, right?
Yeah.
Another topic, in the beginning of my career, I was very skeptical regarding regulatorily driven businesses. So I thought it's very difficult, and we talked about supply chain risk earlier. I always thought, hey, if the government is engaging in a certain industry by imposing new rules, then maybe you wouldn't want to be involved as a capital allocator, because it's difficult to predict and the government might change their opinion. I think it can be a fantastic tailwind for a company also, right? So I mean, there's certain aspects about how you invest where you change your mind over the years, and so I hope I become better. I hope we see it in the numbers. Pretty sure LPs see them.
Yes, that's very interesting. Thank
Yeah.
you, Stephan, for being so open about it.
Of course.
Really appreciate it.
If Andre sees this, congrats again. Fantastic story.
I think many VCs don't want to talk about their failures,
Yeah.
but also interesting to see that you really took a lesson out of it, and also in your fund really learned from it. So yeah, very interesting. Another nasty question. So a couple of months ago, I read a tweet or post on X or whatever you call it today, from a US VC saying being a VC is harder than being a founder. That was deleted very quickly afterwards.
I imagine.
What's your view on that hypothesis?
I think it's complete. I mean, it's tasteless, right? That's why. I mean, he or she. I don't know who wrote it, but they probably got some backlash. No, I think it's a very different job in many regards, and you know it firsthand maybe much better than I do, right? In a VC firm, at least at the partner level, you're working in a partnership. You're trying to make decisions together. The risk is distributed. It's a lot of risk, but the risk is distributed. And as a VC, you have many chances to win, while as a founder, you're very heavily concentrated into one opportunity most of the time. There are exceptions, but most founders work on one thing, and one thing that's all their net worth. And I think that's never to be underestimated, and it's the key difference. What I'm assuming is where maybe that VC came from is that they founded a fund and they had to raise their money and they thought it was very hard. And I agree, it's very hard, but it's nowhere near as hard as, building a self-sustaining company, because in the end, the business model of venture capital, it's complex and difficult, but still it's the model itself has been invented, and what you have to show is pretty clear and obvious, while founders are usually, at least when we're investing in them, on a path into something very new. And so I think it was a bit tasteless. A bit unfair.
I like that conclusion.
Yeah.
Okay, very interesting. So earlier touched base quickly on, I think it was net retention rate as a KPI you're looking at in software. What are other KPIs you find interesting, or maybe even not non-standard KPIs, like not the ones you read everywhere?
Okay.
Are there any KPIs that you have in mind where you say, okay, we look at this and that maybe not everyone looks at it?
Okay, that's interesting. I mean, sometimes people come up with completely new KPIs and then trying to generally apply that to everything. That's not really what we're trying to do. What we're trying to do is sometimes look very specifically at the company and then try to see, do the KPIs that we look at make sense in that context? Because sometimes, and depending on your role, you might have done that. You can drive certain KPIs a certain way, by including certain timeframes or not, or certain aspects of your of the things you could include in them or not, to make it very pretty or very, very dark, right? And I take the very simplified example of customer lifetime value. There's been many books written on how to calculate it. There's many different approaches, and in the end, in the pitch deck or in an Excel file, you just see customer lifetime value, and the calculation can be extremely complicated. It can be extremely simplified, and so it's very important to look deeper behind it. For example, in that case, what I always try to understand is the reality of day-to-day business, meaning, what did the customer pay? How much did you spend on them? And then within the spend, I try to understand, what did you allocate to it? Did you allocate the salespeople that were maybe involved or not? It's a choice. Maybe it's not relevant. Maybe it's super relevant, right? And so you try to go in that kind of depth and then try to see, do you agree? Do you not agree? If I took it in, would it then look much better, much worse? And that again is a very valuable discussion, because it also creates a lot of clarity between you and the investor, and then you both agree what's the good number, what's the future you're aiming for, rather than hiding behind maybe an abstract number. Sometimes what I like to do is, I for example, we're generalists, right? I mentioned that multi-specialist. So I we historically for example, we looked at games companies in the mobile space, and what they do fantastic, and sometimes it's nice to look at that, is they look at every individual user and how they interact with the app and with the game on every level, right? And so that creates a lot of interesting aspects on how to measure and your impact, your success with the user, how they maybe monetize or not, where they come from, if you match that maybe to demographic data. But it's also a lot of data, and so sometimes you have that opportunity to do that in enterprise software, but maybe you don't. And so it's interesting to see what you could do to maybe deliver much better performance, because what we always see is these trends, right? Sometimes the consumer space is a bit further ahead, meaning consumer apps have been fantastic, while enterprise software, if you've been in an enterprise in the last 10 years, was still so. It's becoming better, but still pretty dreadful to use. And using the tools that people use in these modern software products in maybe the enterprise context is a super interesting trend, right? But then we also should use the things they use to measure their success and how they develop and deploy these solutions. And so I like to use, sometimes borrow from different spaces, kind of to see, how we can do things better together. But then that depends on the stage, right? Sometimes it's just too early to measure all these things, and it's not the most important thing. Maybe it's just about very human aspects, such as the people you know and you can sell to, and then it's not a very complex KPI. You just look at an Excel file together and you call a couple of people.
Okay, interesting. So very, very individual, very
Yeah.
based on the exact business model
100%.
and on the KPIs that matter in that category.
Yeah, which is also
Very
a super interesting discussion, right? Because sometimes you measure the wrong things. It's really important to know and have that discussion.
Yeah, interesting. So time is running. I have one question left.
Okay.
What are the big trends that shape the investment scene in software as a service, enterprise software? What do you see that really has an impact on investing in SaaS companies? And is there any advice you would give founders in the respect of those trends?
Yeah, I think a topic that is I'm almost sorry to kind of double dip on the AI in software space. You're so surprised, Linda, right?
I avoided it in my questions on purpose, but
yes, yeah, I think we can't avoid it because and I maybe come from it from a software engineering perspective. It's just been the most impressive thing I've seen in software development and how it changes just software development already. I mean, it's not the solution for everything. That's a lot of hype, maybe overestimated expectations, but it shouldn't, especially when you're a founder, especially when you're working on something new. I encourage you so much to see what it can change for you and how it could change your approach. And I mean, if you're nimble enough as a larger company, same is true, right? Of course, I go a bit towards German cliches because I'm again assuming some of your listeners might be German. Sometimes we have this invitation to maybe send data to a US company and share some things. Build a sandbox. Just try to see what's possible. Because I can tell you, as VCs, what we're doing right now is we're looking through every piece of software and we're trying to understand how are large language models in the broadest sense and the models that we can train based on them changing software, and how can we make things more efficient? Where can we make it much more impactful, do things that were before humanly not possible, right? I mean, we were talking about I make the bridge to the beginning, the company Prewave in the very beginning. They came out. There were many supply chain risk softwares before Prewave, but Prewave came out when a model called BERT became open source. BERT was the predecessor of what we see today at OpenAI. It was a model that was open sourced by Facebook at the time. It was a couple of years before ChatGPT became a huge thing. But it was a huge step forward in terms of NLP and the ability to process and categorize text. And what it enabled Prewave to do is to go through global social media signals and categorize everything with computers. And to do, before people tried it, but it was not possible with the same quality, the same speed, and the same scale. And now this is possible in almost everything. I mean, if you think about your emails, if you think about what's possible, including all the knowledge around you in your daily workflows, I think come from a personal experience and then look at that, because it's probably the biggest opportunity for the next 10 to 20 years, broadly speaking. And the nice thing is it connects to every vertical, and meaning if you're an expert wherever you are, you can think about how does that change my vertical, and so that's why I think there's really some meat to the bone. It's not it sounds superficial, but it's really not.
Yeah, thank you. I think that's a great angle on AI, and different than, oh, I need a chatbot here and I need a chatbot there. Yeah, absolutely agree.
Yeah.
Stephan, Thank you so much for being so open, for telling us so much about how you approach investments. I think it's still for many founders a big, big black box, and you have shed some light on that black box today. Thank you so much. Good luck with all your investments,
Thank you so much,
and
Linda.
I hope we meet in person soon.
Of course. Take care. And reach out to me
Thank
if you have a
you.
company. Bye.
Bye bye.